Hello everyone, and welcome to your Glassnode video report for week 8, 2024. Now today, given the ETFs have been live for just over a month now, we're actually going to do a bit of a big picture Bitcoin market rundown and just essentially go through a couple of different sectors, start with some on-chain tools to really get a bit of a grip on what's going on, start to move over to the derivative space and just do a bit of an assessment of what's going on in the leverage environment. And then close out by actually looking at exchange flows, which are starting to show some very, very interesting patterns and certainly a sign of renewed interest in the asset. So as I mentioned, we've seen the ETFs be live for about a month, or just over a month, and they have performed, I think, much better than most people expected. We've seen, I think it's on the order of about $11 billion worth of inflows, which has been offset in some part by about 50% by GBTC outflows. Nevertheless, they are breaking records left, right, and center, which is quite remarkable, and certainly something that many people in this space probably didn't expect or anticipate. So overall, very, very successful. Now, as a result, Bitcoin has traded up to over 52,000, and it's essentially been holding there since mid-February. So really, it still hasn't given that much of a pullback. Now, what's going to be quite interesting in this section, we're going to talk a little bit about what's going on in the futures market, and in particular, focus on what's going on the short side, because what we are actually seeing is that many investors and many traders are actually still betting against this rally. We've seen that short liquidations have exploded higher. The dominance of short liquidations relative to long liquidations is much, much higher than usual. And it's really telling us that a lot of folks in the futures market are still betting against this trend. So a bit of a balance, but also looking at how much just explosive, this chart you can see down the bottom right here, this is the overall exchange inflow and outflow volume for the two majors, Bitcoin and Ethereum. And you can see here in orange that Bitcoin is just exploding higher. We will cover that more in more detail. So just before we get started, please do give us a rate, a share, and a subscribe. It has helped this channel get to more people. And without further ado, let's get stuck right into the analysis. Okay, so as I mentioned, we're going to start with two sets of metrics to give a bit of a big picture view of where we are in the cycle. Just in terms of actually tracking where Bitcoin is, MVRV, and comparing where the market currently stands relative to the cost basis. We can also do this with the AV/IV ratio that we developed during the Cointime economics framework, but most people are familiar with both NUPL and MVRV, which we'll touch on in a second. And just bear in mind that NUPL is actually a derivative of MVRV. It's essentially a transformation where we're bringing it into the market cap space and comparing the overall profitability of the market relative to that realized cap or realized price. Now, why is MVRV and NUPL a powerful tool for this? Well, at the end of the day, what drives human beings to make decisions? By and large, it is profit and loss. And there are two forms of profit and loss. There's the unrealized component, which MVRV and NUPL both compare and measure. And there's the realized, how much did people actually lock in? So comparing paper gains and losses to actualized, locked in, realized, and that's what SOPA and realized profit and loss are measuring on that spent side of the equation. Now, this chart here, what we've actually overlaid, it's a bit of a funky looking chart, but what we've got is three different variants of NUPL. This is another one of those powers of on-chain analysis that we can break the coin supply down and thus the profitability down by different investor cohorts. Now, if you spend any time watching this channel, you'll know that we often refer to our long-term and our short-term holders. We've got our long-term holders in blue, short-term holders in red, and in orange, we have the average. This is your classic MVRV and your classic NUPL metric. So the top bars up here are NUPL, which is essentially measuring below zero, means that the market on average is underwater. And you'll see that this particular chart will light up when all three cohorts are underwater. And it's really telling us when essentially it's pretty nasty out there. And this tends to correlate with bear market bottoms, which thankfully we don't have to talk about, well, at least not right now. Now, the other side of the equation, which is probably more relevant to where we stand at the moment, is looking at things to the upside, because as the market rallies, more and more people go into profit. And at some point in time, every investor, no matter how diamond-fisted they are, everyone has a price for at least some portion of their stack. And the important thing is that at some point that will overwhelm the inflowing demand. Now, really what we're trying to do with all this analysis is try to establish that supply and demand balance. So the way that we're measuring this, you can see that all three of these have ticked higher. Short-term NUPL is not quite at the levels that we've seen during bull market peaks. The standard NUPL, you can see it's getting into top territory, right? We're starting to get to the relatively high levels. And the long-term holders, they actually have some distance more to go. Obviously, the longer that these people hold from these very, very early bear markets, and even during our FTX bear market, folks who hold for that very long period, you can see that they end up getting very outsized returns. Now, there's a couple of other observations here. We can also see that long-term NUPL tends to stay much higher, much later into the bear market. This is because people will actually hold throughout multiple cycles. So they hold these enormous gains, they hold them on average all the way down to the losses, and then rebuild them all the way back up again. So it's this long-term cyclicality. Note that short-term holders tend to deviate much sooner, followed by the aggregate market, and then last of all, the long term. So we can start to get a bit of a momentum trend, right? We have some people who will actually look at these metrics and how they diverge, how they change shape relative to each other, because the short-term holders will tell you what that hot ball of money is doing. The average market is exactly what it sounds, the average market. And those long-term holders, those slow cyclical tops and bottoms, they tend to be active around the extremes. Now, down the bottom here, you'll see that I've actually flagged the price in orange and red when two conditions are hit. The first one is that we're just looking at things in terms of their standard deviations, right? So how many standard deviations are we hitting? The orange will flag when at least one of these metrics, at least one of these cohorts is above one standard deviation. And it will flag red when at least two of them, can be all three, but at least two of them. And we can see this really helps us identify when things are getting steamy and then really, really heated. So it's trying to look for when is the amount of profit in the system, the amount of paper gains, the incentive for people to sell. When is it getting just a little bit too extreme, at least on a statistical basis? And as we can see, despite the positive price action, and despite the fact that most of these are getting into the, well, not quite the top, but certainly the upper echelons, we haven't actually flagged even the orange yet. So we're still sitting at that level where none of these particular NUPL indicators have actually hit that one standard deviation threshold. Now, I'm going to do a very similar exercise, but using MVRV. And again, we're just going to go through this visually. There's obviously a lot of mechanics and mathematics that people can put behind this to be more precise. But I think sometimes visuals just give you enough of an indicator as to how these tools are, what they're actually describing. Now, this green bar here, I'm going to move it using our workbench tool. I'm using the value at function. And what this is going to do is it's going to return the last printed value for whatever input metric, in this case M2, which is the MVRV ratio. Now, what I really want to just describe here is when are we above this line? Well, it's during really from the start of 2017. This is the real euphoric phase of the bull market. That's really the only time we've been above it. And note that it takes a couple of attempts to actually get above that level. Now, why do we use these levels? Well, human beings have a particular green number where they're going to go, well, I'm up 400% or I'm up 300%. That's my number. Human beings tend to have this, this innate feeling where they've made significant wealth and they start to take chips off the table. That's what I mentioned about the incentive. This is why MVRV will typically get to very similar levels up in the 3.2. When it gets up to these very high levels of 4.4, right? This is really extreme. But you can see we tend to find resistance at these points because people do take profits at those levels. We can see here in the 2021, not quite in December, but as we were rallying up to the 20,000 all-time high, that's when we broke up and above it on both of the all-time high peaks. So you can see we're starting to get into that, it's relatively thin air, but it's also that kind of point of getting close to the breakout for what could look like that euphoric phase. So it's important to note that people do start to take profits in and around this region. And the time that we're above it has typically correlated with some pretty extreme bull market territory. So starting to just frame up the problem and understand where we are. Now let's bring in our short-term holder MVRV. I'm just going to switch this over to M3 just to give you a bit of an example. Again, if we look at the short-term holders, you can see also most of the corrections that we see are when the market is trying to break above this profitability level. And note the change in character back here in 2017. We tried to get above this type of level. And again, this is an arbitrary level, but you can see we've actually tussled with it a couple of times this cycle as well. Once it breaks above, things get pretty wild pretty quickly. So when it gets above a similar level, 1.2, that means that the average short-term holder is up about 25%. That's generally a level we start to see profits. 20 to 40% is very normal for short-term MVRV to find resistance. Above that level, things really start to get into a different regime. So again, just looking for where that regime shift may come into play. And the last one, just to close out our global overview, is looking at the long-term holders. So we're at a very similar level to where we were back here in 2019, again in early 2017, and as we were heading towards the previous all-time high in 2020. So as you can probably see, history may not repeat, but it certainly rhymes. And again, because we're looking at the unrealized profit held by these investors, it's giving us a reasonable signal as to where we sit in that cycle. And given that we're at 52,000 and the all-time high was at 65, in many instances, this looks quite similar. Bitcoin has this amazing way of just kind of repeating what it always does. We're all waiting for that cycle to break, but thus far, it seems to just follow this very organic human market psychology type pattern cycle after cycle. And this appears to be not a great deal difference, although note, we tend to find resistance around these points. So again, just keeping all these things in context. Okay, so switching gears, I want to have a look at derivatives because we haven't actually covered this for a little while on this channel. And it's important to know that as the market rallies like this, people they do get excited when they see, 200% green numbers on their spot position. Some of them transfer some of that across and open up some very high leverage. And ultimately, these things create, they create additional risks within the system. Now, lots of folks will look at open interest in USD terms. And of course, that's very, very relevant. And we're getting up to some pretty high levels, right? As you can see, the amount of leverage in the system, we are in very, very thin air territory, right? So just bearing in mind that this red here is FTX, which obviously no longer exists. So we are talking about a very, very different regime. Now, something else to note the purple down the bottom here. Historically, Binance has been the dominant player when it comes to open interest. But the CME in purple is actually driving a very, very significant chunk of this open interest. And we'll explore this in the next chart. But it's important to note that leverage levels, right, we up over $20 billion worth of open interest. But it's obviously important to keep these things in a relative context. Looking at it in terms of USD can be a little bit, I generally look at it in terms of BTC terms as well, which we'll get to. Because if someone puts on a 1 Bitcoin position, and they're doing some kind of cash and carry trade or something of that nature, that open interest will obviously move with the coin price. So yes, it's important to see how much open interest is in the space, but it's also important to look at it from a relative standpoint, whether in BTC terms or in a couple of other metrics we'll look at in a second, to just say, are we seeing a growth in open interest, or is it actually just the coin price moving and essentially all those positions are just still open, right? So just different ways to think about the problem. Now, this is an important chart. In the orange, we have the open interest, again in USD terms for Binance. And in the blue, we have the open interest for CME. Now, if you've been following this channel for a while, you'll know that October was a major phase shift in the market. We saw things change, new capital coming in. This was essentially hodlers only. Only the people who survived the bear market and FTX didn't scare them thinking that Bitcoin was dead for a decade, which was the narrative at the time. This was a very hodler-only market. When we broke through 30,000 and news of the ETFs and the probability started picking up and we started seeing new money and it came in a very serious way. And this chart, like many others, shows the CME absolutely exploding and actually taking over Binance as the primary trading venue, just shy of $7 billion worth of open interest. And at the end of the day, CME is just a different exchange. It is a regulated US market exchange. It's not one of these offshore exchanges that kind of exists in the crypto space for a long time. We are talking about a maturation phase that is going on, and we can see it across many layers of the data. Now, talking about the amount of leverage. So this is where we just want to do a bit of a diagnosis and understand, is the leverage building? Is it getting too heavy? What direction is it in? I like to look at funding rates, and here I've got them annualized just to make it nice and easy to digest and understand. We've got the 3-month rolling basis. This is if you're doing a cash and carry trade with expiring futures on a 3-month basis in blue, and then in orange we have the annualized funding rate. Now it's important to note we are in positive territory. And you can see here that we saw a significant uptick following that October rally. So we did see the market get a breath of life from that point on. It's been pretty dead, more or less, for 18 months before that. But note that the amount or the rate at which people are willing to pay, there was a bit of speculation into the ETF, but that cooled off pretty quickly. We're talking about rates of 10%, 14%. Now, we're in a 10 or 5.5%, percent interest rate world. And as a result, something on the order of 10 to 14% for doing a cash and carry trade with Bitcoin on a futures exchange, it's kind of describing a real world of risk and yield. So in many ways, we've seen that the in August last year, this was actually trading it below the treasury yield, which really is very hard when you've got yields in Bitcoin futures market of 3%, and you can put cash in a treasury at 5.5. There's not a great deal of reason to attract liquidity. When you've got rates that are 2 or 3 times more than that risk-free rate, for doing a cash and carry trade, which, there's always risks and counterparty risk, but it's less risky than just holding a volatile asset. In that instance, this is starting to attract capital back into the market, and that's a key feature. Now, also note that we are nowhere near, we got to 80%, 100% level of funding rates during the 2021 bull market. We are not even close to that. And again, interest rates are higher than they were back here, which was 0. So we are talking about that spread between both treasuries and funding rates. We're talking about just the amount of leverage. It's just not quite at the same magnitude as this, which was pure insanity and pure chaos. If you lived through that, this is what it looked like. It's 50% down in a very short span of time. That was a major deleveraging event. So we are positive, but we're not rip-roaring extremely insanely positive. So again, it kind of aligns with NUPL that we looked at the start. It's heading higher, but it hasn't yet quite flagged any of those very, very high and somewhat insane levels. Now, this chart, I think, this is actually my favorite from this session. This is the long liquidation dominant. So basically, we're looking at all of the positions that were liquidated in futures markets and saying if it's a positive number, that means that they were predominantly longs, right? So you can see here, FTX blows up. Everyone who was long wiped out. Now, we had a very significant short squeeze here in January last year that actually kicked off this uptrend. That was kind of the initial trigger. There was a lot of spot buying down here, but that short squeeze is what gave it the juice to actually get back up to this $20,000 level. Note that in this October rally, now, of course, in an uptrend, obviously more shorts are going to get liquidated because it's heading in the wrong direction. But note the depth of this, because people get chopped up all the time. This metric is generally positive because people tend to go long more than short. Nevertheless, we have seen significant shorts all the way through into the ETF. The ETF sell-off down to 38K saw a couple of longs kick in, but this rally in particular really wiped out a lot of shorts. So this October rally, despite all of the signals that we've had very, very strong capital inflows, we've been covering this for, more than the year to date, but each week we've been looking at growing capital inflows into this space. And strangely enough, people continue to bet against this rally. People were betting that the speculation would be short-lived. People were betting that it would be a sell the news event, which it kind of was, but not really, because here we are at 52,000. So we are still seeing people betting against the trend. Now, generally speaking, when you have this euphoric chaos, there are no shorts. It's only people getting liquidated on the long side. Note this, we're at all-time high and people are getting liquidated on the long side. This is because the volatility on these tiny little, all the intraday movements is wiping out those heavily levered, overly euphoric long traders. We don't have that. We actually have a very balanced market where people simply still don't believe that Bitcoin's at 52,000 and they are betting against it. And generally speaking, this is usually the sign of a healthy market, having enough people on both sides, plus funding rate yields that's going to start attracting liquidity. All of these things are describing a relatively healthy uptrend. It's generally speaking good to see, to have, people betting against the trend, because ultimately when everybody is long, there's no one left to buy. And that's kind of the nature of how markets work. It's this concept that when everyone's on the wrong side of the boat and things go the other way, that's when everyone gets shaken out of their position. Right now, people are actively betting on the short side. Now, it's also important to note that those traders who are doing a cash and carry yield capturing strategy, they are neutral. So yes, they're going to show up in the open interest metrics, but they're unlikely to get liquidated unless they make some serious mistakes. Generally speaking, we're talking about directional traders in this instance who are actually betting against the trend. So just an interesting observation, and I think quite a bit of useful information baked within there. And here's just a view of the liquidations. You can actually see, I mean, again, visually, we can obviously do the numbers on this, but you can see that through the course of 2023, it was kind of choppy. People going in both directions. We had a couple of longs, a couple of shorts, but generally speaking, we traded nowhere and lots of people got liquidated along the way. We can visually see that lots of shorts keep betting against each and every rally. So we're actually seeing this playing out in the liquidation data as well, which remains quite interesting. Now, I mentioned when we would talk about open interest to look at things in a relative basis. Well, there's two ways we can do that. Well, there's many ways, but here's two. The first one is just to price it in BTC terms, because then what we're doing is seeing, are we seeing a growth in leverage? Are people opening more Bitcoin sized positions rather than the coin price? It's a nice way to kind of filter that out. Now, we have to remember that this giant weird looking spike was indeed weird looking. You can see when it actually ended, kind of had something to do with a weird exchange that doesn't exist anymore. So there is going to be a bit of an aberration in the data here. Nevertheless, we are not, we are heading up to relatively high levels, right? Similar to where we were at the all-time high, but it's absolutely nothing like what we saw here. And we can see that that downtrend wiped out, quite literally, all of this leverage. So if we zoom in just on our last year, we're not even at the highest level. We can see this was a level of high open interest in BTC terms, and we actually had a sell-off. We did a report back here called Volatility Squeeze, and there was another one, Exhaustion and Apathy, I believe, which was the derivatives and the on-chain side. I would actually strongly recommend people go back and check this out here in August 2023. Those two reports and the two videos we did, really great example of using derivatives in the first one, Volatility Squeeze, and then the second one is Exhaustion and Apathy, was how we can measure volatility in the on-chain world. And they told a very similar story that lots and lots of people were not ready for a downdraft. And that's, of course, what we ended up having. So leverage has picked up over the course of this rally, but it's actually been in a downtrend as we've headed higher into the ETF news. So again, just how we can measure leverage and just put things into a relative perspective. Now, the other way we can look at it is how big is the open interest? Let's think about that. If that's the leverage that's going to cause a deleveraging, I bring back the engineering framework. This is the force to make the market want to move. And the thing that it's trying to move is essentially the market itself. So you could do a denominator of market cap. Here we're looking at the estimated leverage ratio, which is open interest divided by the spot balance on the exchanges. So kind of comparing derivatives and spot, and we can see a very, very similar structure. And actually this is continuing to trend lower. So on a global scale, whilst the USD open interest is high, a lot of this is being driven by CME. And this is a very different market structure to what we're essentially used to. And the market is evolving. Market structure is changing. These ETFs are going to change it. And the dominance of CME is also going to change it. So we are seeing these dynamic components starting to move and shift around within the Bitcoin market. Okay, so the last topic we're going to talk about is spot exchange flows. And we're going to start here. This is just looking at inflows and outflows. There's two insights from this one. Obviously, inflows we've got in green, outflows in red. These are all priced in BTC. The first one I want you to note is that we are seeing an uptick overall in exchange flows. I'm actually going to come back to that on the next chart, which I think describes it a little bit better. The other thing to note is that on any particular day, and this is something that a lot of people miss, particularly when they're looking at on-chain data, a lot of critics of on-chain data don't quite recognize this component. On any particular day, right? Let's just take the last couple of days. 65,000, 70,000, 68,000, 52,000 Bitcoin flowing in and out every day. This is an extraordinary amount of volume, right? We're talking about tens of thousands of Bitcoin flowing in and out each day. And you can see that the net, this tiny black line, which is taking the net between those, this is the one-day change of exchange balances. Generally speaking, the inflows and outflows have a lot more signal than the net balance, because you can see the net balance change, it kind of just squiggles around not much. But what we see going on with the inflows, every single one of those 70,000, 60,000, 30,000 Bitcoin flowing into exchanges, particularly inflows, is carrying a signature from its holder. Was it a long-term holder? Was it in profit? Was it in loss? Was it large? Was it small? How long was it held for? These are all, what was its cost basis? These are all pieces of information that are baked into it. And this is why on-chain data is so powerful, because there is such an enormous amount of volume going in and out of exchanges. And again, mostly the inflows, because that's the investor to the exchange rather than the exchange to the investor. We are seeing a huge amount of data that we can really gauge sentiment, right? Because there's a lot of Bitcoin holders who do in fact just hold it on chain as spot. So that's giving us a really powerful signal into what is going on in the space. Now, this is the chart that I want to close on, and I mentioned that expansion of inflows. Here I've brought it back to USD for one reason, because we compare BTC and Ethereum, the two majors. I think this is a really, there's a lot of insights we can pull from this chart. First thing we can see, 2021, 2017, and where we currently are, note that Bitcoin in orange moves first. During the, following a bear market in the hangover period and then in the start of the uptrend, historically speaking, Bitcoin moves first. The market looks for Bitcoin to move first because it's a sign of confidence that the digital asset space is in fact coming back to life. Green shoots are growing, and we can see it very clearly that Bitcoin interest is absolutely dominating pretty much every metric. When we look at it from, I don't have the charts in front of me, but when we look at it from open interest dominance between the two majors, Bitcoin is still at 67, 70%. When we look at open futures trade volume, again, Bitcoin is dominating 65, 70%. So we are seeing that initial influx of capital generally comes into Bitcoin first. And after the market has achieved some kind of escape velocity, that's when we actually see speculation pick up and assets or capital start flowing further out on the risk curve, as is demonstrated by Ethereum inflows and outflows picking up. So where we are at the moment, you can see this explosive uptrend, and essentially in terms of inflows and outflows, which is a bit of a proxy for the interest to trade, right? Investor interest in Bitcoin and digital assets by and large, we are getting up towards all-time high levels. We're not quite at this apex here, but again, these things tend to be short-lived. This thing here has essentially been growing, and most particularly since October. So you'll see why I keep coming back to October. Something really changed meaningfully in investor mindsets at that point in time. And, almost literally, it's been rallying ever since. So a really cool chart. There's a number of ways we can view this. We can look at it in terms of realized cap 30-day change and a whole bunch of different things. They all tend to describe the same, which is that Bitcoin dominance is kind of a prerequisite for the market to come back to life following what are truly pretty damaging and pretty hairy bear markets to go through. So if you made it through this one, and if you made it through this one while watching the channel, thank you very much. But hopefully this is a useful piece of insight just to kind of see how the market likes to move under the surface. So thanks for tuning in for that session, folks. Hopefully you found that useful. A bit of a big picture overview, starting with the on-chain, just kind of mapping out and saying, yes, there's no question we are in positive territory. And there is not a great deal but thin air above us across many of those metrics, which is quite exciting, but also quite surprising how quickly it can go from, it's over for 10 years to 52,000 and things are really trending in the right direction. We are clearly seeing that investor interest come back in. I mean, you can see it in that spot inflow and outflow. It's pretty undeniable. I mean, again, these things happen on both sides. There's inflows and there's outflows, but this is a proxy for trade activity. We're seeing interest come back to the space. And in terms of the derivative side, we're at, relatively high in terms of open interest, but a lot of this being driven by the CME. We're definitely positive in terms of funding rates, and that's going to attract more capital because people can get 10, 14, 15% by putting on a cash and carry trade. That's going to bring market capital back in, trying to look for something above the risk-free rate. And the other component that we have is that people are still betting against this trend, which is, given the strength of the market, a lot of this has been driven by those shorts that just keep getting squeezed higher and higher. But at the same time, Bitcoin still hasn't given back a 20% correction since the FTX lows, which really is quite remarkable. Of course, who knows whether that plays out into the future, but certainly it's a sign of strength as long as it lasts. So anyway, thanks for tuning in. Hopefully you found it useful, and I'll see you in the next one. Cheers.